Welcome back. Today, we step into the adult world of investment, commercial property. For many, commercial real estate feels like a distant mountain peak, reserved for institutional funds, massive corporate players, or the ultra-wealthy. They see the higher deposits, the shorter loan terms, and the perceived complexity, and they back away. But let me tell you a secret. The greatest opportunities often hide behind the highest barriers to entry. The moment you shift your mindset from where will I live to where will my money work hardest is the moment commercial property becomes not just accessible, but essential to your long-term portfolio. Today, we are going to demystify this asset class. We will break down the two distinct worlds of commercial property, identify the golden opportunities that exist right now, and most importantly, show you the three terrifying pitfalls, the absolute trash assets that you must avoid at all costs. This isn't just about higher rental yields. It's about superior cash flow, greater lease stability, and a lower level of emotional churn compared to residential investment. So, grab your pen, put on your analytical hat, and let's dive deep into the Commercial Property Playbook. Part 1. Defining the asset. The two worlds of commercial real estate. When we talk about commercial property, the term is far too broad. For the sake of finance and risk assessment, which is the only language the banks speak, we need to divide the world into two camps, the traditional and the non-traditional. The traditional trio. The traditional commercial assets are the bread and butter of the investment world. These are the assets that banks understand, that have predictable valuations, and that have decades, sometimes centuries, of transactional history. They are the core pillars of any economy. Industrial. This encompasses warehouses, distribution centers, factories, and light industrial units. Think logistics, supply chain, and e-commerce fulfillment. Retail. This includes streetfront shops, units within larger shopping centers, and standalone retail premises. Think shops, restaurants, and medical centers. Office. This covers everything from small suburban suites to high-rise CBD towers. Think professional services, corporate headquarters, and administration. Banks love this trio. They have clear lending parameters, established valuation methods, and they are generally willing to be flexible with terms, assuming a solid tenant and location. The non-traditional niche. Now, this is where it gets interesting and often riskier. Non-traditional commercial properties are specialty assets. They don't fit into neat boxes, and their value is often intrinsically tied to the business being operated within them. These might include boarding houses or shared living, a single house or building with many individual rooms rented out, student accommodation blocks, car parking stations or spaces, single title block of units, a block of apartments all held under one commercial title, service stations, petrol stations, motels and hotels, specialized assets like aged care facilities, or yes, even high-end, niche businesses that are difficult to finance. If you're a novice investor, you must understand this fundamental rule. Do not start with non-traditional property. The lending is complex. You're dealing with non-bank financiers, specialist funds, and a much higher level of risk. Your entry point should be the traditional trio. Part 2. The golden child, the industrial juggernaut. If there is one category I'm excited about right now, it is industrial. The pandemic didn't just disrupt supply chains. It fundamentally proved the value of local storage, distribution, and manufacturing capability. The industrial sector is the golden child of commercial real estate. Why? Superior yield. We are seeing yields that can push well past 6.5% and even into the 8% range, especially in the outer metropolitan hubs. Compare that to residential yields of 3% or 4%, and the cash flow difference is profound. Robust capital growth. The land component in industrial assets is often significantly larger than the building itself. As demand for strategically located, flat land near major transport corridors explodes, the scarcity of that land drives impressive capital gains. Tenant profile and stability. Industrial leases are often longer, 3 years, 5 years, sometimes 10 years with options. The tenant is usually a business that has sunk significant capital into machinery, fit-out, and logistics setup. Moving is an astronomical cost and hassle. This creates sticky tenants and reliable, long-term income. The industrial pitfall, the CBD fringe trap. But here is the danger, the first major pitfall, the CBD fringe industrial property. As investors, we are instinctively drawn to things that are close. We think proximity to the city core equals value. For industrial assets, this can be a huge mistake right now. The problem of price, due to rezoning pressure and the sheer demand for inner-city land, the price per square meter for industrial land near the CBD core is astronomical. You are paying a premium that compresses your yield down to residential levels, maybe 3% or 4%. The loss of function. The purpose of industrial property is function and scale. A massive logistics company does not need an old, cramped, expensive warehouse 10 minutes from downtown. They need a 10,000 square meter megashed with a dozen loading docks and easy access to major arterial roads, which you find in the outer metropolitan hubs. The smart play, go further out for land sovereignty. The savvy move is to look 30 to 60 kilometers out from the CBD along major logistics corridors, where you can acquire a much larger block of land for the same capital outlay. You want to prioritize the land-to-building ratio. When a new warehouse is built, the building depreciates. The land, especially large, flat, usable industrial land, appreciates. The better your land ratio, the better your long-term capital growth potential. Don't be seduced by the CBD address. Bet on the supply chain. Expansion detail, the triple net lease advantage. A huge advantage in industrial property is the prevalent use of the triple net lease. Unlike many residential and retail leases where the landlord covers structural repairs, rates, and insurance, in a net lease, the tenant often pays for all outgoings, which include rates, taxes, insurance, and maintenance. This makes your income truly net and incredibly predictable. This is a massive differentiator for industrial property cash flow. Part 3. The Retail Minefield. Retail property is the most deceptive category. It feels familiar because we shop every day, but it's riddled with hidden traps. For every stable, high-performing shop, there are 10 that are financial black holes. The Retail Pitfall 1, the apartment gutter shop. This is the single greatest piece of commercial trash on the market right now. And I see novice investors getting suckered into it every single month. The asset, a small, ground floor retail space, let's say 50 to 100 square meters, located at the base of a brand new, multi-story residential apartment complex. The lie. The developer pitches it as a convenience asset, saying, it serves the 300 residents above it. Great foot traffic. The reality. No parking is a death sentence. These units are often built right up to the boundary on a main street, offering zero dedicated customer parking. If a customer can't pull up for 30 seconds to grab a coffee or drop off dry cleaning, the business fails. Parking is the lifeblood of suburban retail. The prisoner economy. The business relies solely on the small, captive economy of the apartment residents upstairs. That's not a market. That's a prison. You cannot raise the rent year after year because the tenant's income is capped by the 300 residents. The moment they leave, the rent often drops to zero because the next tenant knows the game. Low appraisals. When you try to sell this asset, the appraiser knows the truth. They cannot value it on strong rental growth, only on the weak captive income. These assets rarely, if ever, appreciate. They're simply a developer's way of monetizing an otherwise dead space. Rule. If a retail unit is on a main road, but offers no visible, dedicated parking and is not part of a major retail chain, like a bank branch, avoid it like the plague. The retail opportunity, the anchor tenant in the strip center. The counterpoint is the high-performing retail that works, the strip center. Anchor tenants. Look for retail properties anchored by essential services. Supermarkets, pharmacies, medical centers, or long-term childcare facilities. These businesses are recession-proof and pandemic-proof. They create the foot traffic for the smaller, surrounding shops. Community hubs. Look for the retail pockets that are the undisputed gathering point for a well-established suburb. These centers have high foot traffic, strong demographics, and decades of entrenched social habit. Lease structure. Good retail properties have leases with yearly CPI-linked or fixed percentage increases, ensuring your income grows. They often have high fit-out costs for the tenant. Think full restaurant kitchens or medical fit-outs, which encourages them to stay, similar to the industrial tenant stickiness. Expansion detail. The tenant mix strategy. The most successful retail investors actively manage the tenant mix in a center. You don't want 3 coffee shops next to each other. You want a pharmacy, a doctor, a cafe, a hairdresser, and a convenience store. This diversification stabilizes the center. If the coffee shop goes broke, the pharmacy is still drawing 500 people a day past the vacant unit. The value of the asset is often in the synergy of the tenants, not just the income of a single unit. Part 4. The office sector, prestige, and the post-COVID reality. The office sector is the most volatile post-2020. The narrative of work from home has decimated the value of certain office assets, while paradoxically strengthening others. The office pitfall 2. The Class C suburban suite. The pandemic exposed the Achilles heel of the low-grade, poorly located office. The functionality crisis. If an office space is old, lacks modern amenities, has difficult parking, and requires a commute, employees, and thus tenants, will abandon it for working from home. These are the Class C assets, and they are bleeding vacancy and rent reviews right now. The office opportunity. The Class A prestige play. However, the high-end Class A office in the CBD core is proving resilient. Why? Not always because people are going in 5 days a week. It's about something far more psychological. The assurance factor. Many companies, especially law firms, financial services, wealth advisors, and high-tech firms, rent an expensive, prestigious office not for their employees, but for their clients. Renting an office in the highest tower in the CBD core is a statement. It's a multi-million-dollar suit. It tells a client, we are financially stable. We are successful. Your money is safe with us. It's an assurance cost. So when investing in office space, you must ask, does this office asset provide prestige, face, or a competitive advantage to its tenant? If the answer is no, it will struggle against the work-from-home revolution. If the answer is yes, that tenant is locked in because their reputation is tied to that address. Expansion detail, the co-working threat. We also have the co-working threat. This has put downward pressure on smaller, traditional leases. This is another reason to favor the high-end Class A asset. The co-working giants are not usually competing for a law firm's 500 square meter corner suite on the 40th floor. They compete for the flexible, short-term space, which is typically the Class business-to-consumer market. Avoid that middle ground. Part 5. The financing shift, thinking like a fund manager. Let's touch on the practical barrier, financing. This is where you must stop thinking like a residential buyer and start thinking like a fund manager. The general rules for commercial property finance are harder than residential. Higher deposits. Expect a down payment of 30% to 40%, sometimes more, depending on the asset class and tenant profile. Banks view commercial income as inherently more cyclical than a private homeowner's ability to pay their mortgage. Shorter loan terms. Residential loans are 30 years. Commercial loans are typically 10 to 15 years, with the loan likely needing to be refinanced or renegotiated every 3 to 5 years. This means you need a solid financial plan for the future. Interest rates. While the gap is closing, commercial interest rates are generally higher than residential owner-occupier rates, reflecting the slightly higher perceived risk. The lender's hierarchy of value. Banks value the asset based on 2 things: the asset itself and the strength of a lease. The strongest lease, a national blue-chip tenant, such as a major supermarket, a government department, a large pharmaceutical company on a 10-year triple net lease. This is gold. The weakest lease, a local, independent business, such as a retail shop, on a 1-year gross lease. This is viewed as high risk. When investing in commercial property, your true negotiation is the lease. A strong, long-term lease with built-in increases is what secures the best financing and, ultimately, the highest valuation. The tenant's signature is your greatest asset. Expansion detail, calculating risk and cap rate. The golden metric in commercial real estate is the capitalization rate, also known as cap rate. This is your net operating income divided by the purchase price. $100,000 net income divided by $2 million price equals 5% cap rate. Residential investors focus on capital gains. Commercial investors focus on the cap rate. It tells you the effective return on your investment immediately. When you are comparing a suburban office at a 4.5% cap rate to an industrial warehouse at a 7% cap rate, the decision becomes purely mathematical. You remove the emotion. Part 6. Final warning and the opportunity matrix. To wrap up, let's distill this into an actionable opportunity matrix. The golden opportunity, which you should take. Outer metro industrial. Large land component. High cap rate like 6.5% plus. Long-term triple net leases to logistics, warehousing, or light manufacturing tenants. Bet on the supply chain, bet on scale. Strip center retail, anchored by non-discretionary, essential services such as medical, pharmacy, or major supermarket. Excellent parking and high, predictable foot traffic. Bet on human habit and necessity. CBD Class A office, premium location, prestigious address. Tenants pay for the assurance and face value. Bet on corporate ego. The financial black holes, which you should avoid. The CBD fringe industrial. Yield compression too severe. Too expensive for functional use. The apartment gutter retail. No parking, captive economy. No rent growth, zero capital appreciation potential. The Class C office suite. Functional obsolescence and direct competition with a permanent work-from-home model. Commercial property offers a path to financial freedom built on strong cash flow. It's a different game, played by different rules. But once you understand the pitfalls and the opportunities, your portfolio will have a good performance. Thanks for listening, and see you next time.